Lam Research crushed the quarter, but China and Taiwan now make up more than half of revenue. And one export control headline could rip a hole in this whole story. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Lam Research, ticker LRCX for Q4 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. Alright, revenue came in at $6.72 billion, which is only about 1% above the estimate. But here's the part that matters. That's up 30% year over year and 15% sequentially. That's not a small beat on a big number. That's real acceleration. And on EPS, they beat by about 8%, landing at $1.82. So a modest headline beat, but the sequential jump tells you the operating leverage is kicking in hard. So on the beat itself, this earns a B. Revenue barely above the estimate keeps this out of blowout territory, but the EPS beat combined with the size of the numbers underneath makes this a solid, respectable beat. And on consistency, this earns an A. Lam has been quietly beating quarter after quarter, and this print just extends the streak. So let's start with the top line. $6.72 billion in revenue, up 30% from a year ago, up 15% just from last quarter. That kind of acceleration in chip equipment is driven by AI demand from the leading edge customers, and it's exactly what you want to see. And that ties right into the margin story. Non-GAAP operating margin hit a record 38.4%, up 3.5 percentage points from last quarter. That's operating leverage working exactly how it's supposed to. Then the guide comes in, and honestly, this is the part that made me sit up. They're calling for $8.1 billion next quarter, which is another 20% jump sequentially, and EPS moving from 182 up to 215. Guides like that in this industry are rare. And here's the piece a lot of people miss. Customer support revenue. That's the recurring stuff. Spares, service, upgrades grew 43% year over year to $2.47 billion. That's the piece that turns Lam from a pure cyclical name into something more durable. And they backed all of that up with capital return. $3.85 billion in buybacks over the full year, actually shrinking the share count. When a company is generating cash and shrinking the float at the same time, that's a good place to be. So on profitability, this earns an A. Record margins, expanding operating leverage, and a guide that pushes margins even higher. This is about as clean as it gets on the profitability line. So here's the one that keeps me up at night. China is 26% of revenue, and Taiwan is 27%. That's over half the business sitting in two regions where U.S. export controls have historically moved the entire sector. Management called it out in their forward risk language for a reason. Operating expenses are also climbing. R&D grew to $643 million, and SG&A jumped to $322 million. Total operating expense is now $965 million. It's the cost of staying ahead on technology, but it's eating into how much of that revenue growth drops to the bottom line. And this one flew under the radar. Working capital was an $860 million drag on operating cash flow because accounts receivable jumped by $1.2 billion. Customers are stretching payment terms as shipments surge, so revenue is accelerating, but cash is getting tied up. One thing I want to be upfront about. We didn't get an earnings call transcript for Lam this quarter, so I can't validate the color on things like node mix or high bandwidth memory capex the way I normally would. The numbers speak for themselves, but I'd love to have heard management walk through the guide. And last, the tax rate. GAAP effective tax rate moved from 9.2% up to 10.9%. That's small in isolation. But if it keeps drifting higher, it'll compress EPS growth even if operating income keeps expanding. On guidance, this earns an A. The step up to $8.1 billion with margin expansion baked in is a genuinely aggressive forward call, and management doesn't put numbers out there like that unless the order book is already visible. And on red flags, I'm at a C. Nothing here is broken, but the China and Taiwan concentration combined with the receivables build our real risks I can't just wave off, especially in a sector that trades on export control headlines. Putting it all together, Lam Research delivered a genuinely strong quarter with record revenue, record margins, and a next quarter guide that's the real headline. The customer support revenue, growing 43% year over year, is the piece that quietly changes the story on this stock. It's shifting from a cyclical name to something more durable. The one thing I keep coming back to is the geographic concentration, and that's the ceiling on how bullish I can be. Overall, I'm giving this print a B+. Real quick before we get into the report, if you're getting value out of these review videos, do me a favor and hit that like button and subscribe to the channel. It's completely free, it takes 1 second, and it's genuinely the biggest thing that helps this channel keep growing. Alright, let's get into it. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. Chasing this print on the open is usually where I get punished, so I'm not doing that here. My plan is to give it about 2 weeks and look for a pullback of 3 to 7% before I make my move. Instead of buying shares outright, I'd rather sell cash secured puts around the 25 to 30 delta and get paid to wait. So for me, it's wait for the pullback and sell puts. The guidance raise gives me confidence to sell, puts a little closer to the money than I normally would on a chip equipment name. But I still want my strike to survive a 15% drop if export control headlines out of China hit overnight. I'm focused on the 30 to 45 day window, where implied volatility is still elevated but hasn't fully collapsed yet. So I sell closer strikes, but I respect the China risk. This print checked every box I care about: record revenue, expanding margins, and growing support revenue. If shares pull back 5% or more in the next month, I'm treating that as a gift and adding. Trimming into strength on a guidance raise like this is exactly how I've cost myself real returns in the past. So I'm holding and adding on any pullback. If my covered call strikes are stuck below where the stock is trading now, I'm rolling them up 10 to 15% above the current price. I'm also pushing out to the 45 to 60 day expirations to grab that fat post-earnings premium while it's still there. On some of my calls, I'd actually just close them entirely and let those shares run free into the next print. So my move is to roll up and out. The customer support revenue growing 43% year over year tells me this is turning into a higher quality compounder, not just a cyclical name. If my leaps are deep in the money and getting close to expiration, I'm rolling them out to 2027 or even 2028 to cut down on theta decay. I'm sizing this so a 20 to 25% drop on an export control headline doesn't force me out of the trade. So I'm holding and extending duration. If I'm underwater going into this, the guidance raise is the fundamental confirmation that turns this into a winner over the next 12 to 18 months. I'm not dumping all my capital in at once. I'm scaling in at 5, 10 and 15% below the current price. The one time I don't add is if my position is already too big or if a China policy headline hits before I've finished scaling in, so I average down in pieces. Bottom line, this print earns a B+ from me. Strong numbers, a bold guide, and a structural story that's getting more interesting quarter by quarter, but the geopolitics is the piece I'll keep watching closely.